Hi, this is Selena, and today I have a great video to share with you about how life insurance works. I'm going to make life insurance as simple as possible. It can be a very complicated subject, but after this video, you will understand how life insurance works, and you'll be able to have more confidence in when you're choosing the right life insurance for yourself and your family. So before I get into the content of the video, if you have not yet subscribed to the channel, please consider doing so if you find value in what we present in the series of different videos that we have on our channel. And also like and comment and share our video with people that you know that may benefit from this information as well. So I want to start by talking about the different types of life insurance. There are many kinds of life insurance, and we get bombarded with advertisements about purchasing life insurance. And maybe you have heard a lot of different things about life insurance and how it can be used, but I'm going to clear it up in a very simple way for you. So the first thing to understand is there's mainly two types of life insurance. It's either going to be a temporary plan or it's going to be a permanent plan. And what does that mean? A temporary plan is going to cover you for a specific amount of time, and then after that, it's going to expire. And then a permanent plan does not expire. It can be with you for the rest of your life and offer you coverage for the rest of your life. So let's look at the two categories. So the best way that I can describe this is you have temporary insurance and you have permanent insurance. Temporary insurance is also called term life. You will see a lot of advertisements about it. Term life is very relative to permanent insurance, is pretty inexpensive in terms of the monthly payments to this insurance. And there's two ways to get it. You can purchase it through your job. They have group term, or you can get it on your own, and it's called term life. And then what you will see is that when you get this term insurance, and I'm speaking in generalizations because there are hundreds and hundreds of insurance companies that market these products, but for the most part, you're going to see that you can get a 10-year plan or a 20-year plan or a 30-year plan. And what that means is you're covered for a specific amount of time. So let's say you are 35 years old and you purchase a 30-year plan. You are covered for that amount of time, but at the end of that time, after 30 years, if nothing happened to you, then there's no benefit there. It's going to expire. What happens after it expires? Well, you will hear things like, oh, you can just renew it, or you can just get another plan. But you have to understand how life insurance works. When you purchase insurance, life insurance, they're going to evaluate your risk of loss of life, because one of the main things for life insurance is if you pass away, there's going to be a benefit to your family. So let's say, for example, you purchase a 30-year life insurance and you get $300,000 worth of coverage. Let's just use this as an example. Well, if you pass away between the 30 years time frame, then that $300,000 is going to go to your beneficiary. So if you purchase a 30-year plan and when you turn 65, at that point, if you want to try to renew it, first of all, you still have to be healthy to qualify. And secondly, the price is going to be much higher to purchase it at age 65 than to purchase it at age 35. So this is why getting life insurance, the younger you are, is going to be cheaper. And also the healthier you are is going to be cheaper as well when it comes to your monthly payments. So this is, in a nutshell, how term life works. Permanent insurance does not expire. It will continue and pay for you all the way through until you actually pass away, as long as you keep that policy in force. So I want to share with you about the different types. There's one called whole life. There's another one, universal life. Okay, and then there is variable. There's variable life and also variable universal life. And then the newest version of life insurance is called index universal life. So these are the main types of permanent life insurance. Now, one thing that all of these permanent life insurances have in common, besides that they're not just going to terminate after a specific time, is that they all build something called cash value, which means that the policy is set up like this. There are two components to the life insurance. One is you have the actual insurance coverage, and then they have this cash value account. And then this is where money builds up in the policy, and you actually get a statement every year showing how much savings you have there. And then this savings gets some sort of growth rate on it. It could be interest, it could be dividends, it could just be the investment growing in value. But basically you have a cash account attached to your life insurance. So as you're making your premium payments, some of that money is actually paying for the benefit of having the insurance. So let's say you have a $300,000 policy in my first example here, and then you also, some of that money is going to build into the cash accumulation, and then this money is going to grow and grow and grow, and you're going to have cash that you can borrow against or withdraw. So all of these have that, okay? All of them have it. But what makes these different are a few things. And so I'm going to share that with you. So whole life was the first type of permanent plan that ever was invented. So how it worked is that the money that you pay every month, that is called a premium, is fixed. So if they set you up for $200 a month, you're going to continue to pay $200 a month, $200 a month, $200 a month. That will be fixed. And also your insurance amount on the base of the policy is also fixed. So you can't change this amount. You can increase it by adding more insurance and purchasing more insurance, but the base of this is not going to change. Okay? And then also the interest that's earned on this cash value account is also fixed. So if they tell you it's going to be 3% interest every year, then that's fixed. You're going to continue to get 3% all the time. So whole life is, generally speaking, a fixed product. The premium, the monthly payment you pay is fixed, the base of the policy is fixed, and the interest that you're going to earn is fixed. Now, some whole life policies allow you to get dividends based on how well the company is doing. They will pay you extra returns based on those type of dividends. But for the most part, all these things that I've just talked about are fixed. Okay. Now, universal life, this was very popular in the 70s. And then in the 80s, they developed this thing called universal life. So what did universal do? Well, they kind of changed everything and made it more flexible. Okay, so anytime you see this word universal, just think of flexible. It means flexible premium, flexible. You can adjust the base of the policy, the insurance coverage, and also the interest that you earn may fluctuate based on how the interest rate environment is. So for example, this money that you pay every month, let's say it's set up at $200 a month, but you want to build your cash value faster, you can, instead of paying $200 a month, you may decide to pay $300, $400, $500, or whatever the maximum the policy allows you to pay. So you can increase your cash value faster. Also, this insurance amount is also flexible in the universal life policy. Let's say right now you can only afford $300,000 coverage, but later you decide that, now you have a family and a mortgage and you need more coverage and you make more money, then you want to increase your base amount, which is also called face amount. You can put in an application to increase from $300,000 to $500,000, for example. So it's flexible. If you can pass the underwriting and get that increase approved, you can do that within the same policy. And then your cash value, the interest is also not fixed because it is going to follow the interest rate environment. See, in the 80s, the interest rates were very high. Even I remember people would get mortgages for 15, 16, 17%. So at that time, the interest rate environment paid a lot of interest to these policies. But as the interest rate environment went down, then what happened? These interest rates started to go down and these did not perform as well. So this is what happened in the 90s. And that's why this insurance was invented basically and started to get very popular. It's called Variable Universal Life, also known as VUL. And it had the same structure of any permanent policy, but it had the additional benefit of being universal in this variable universal, which means flexibility, right? So this was flexible, this was adjustable, but then here in the cash value in a variable account, this money was directly invested into the stock market, for example, and then they would do something like funds, and then you would pick and choose how you want that money invested. And then in the 90s, pretty much you could choose anything, close your eyes, and you would get a return because the market was doing so well in the 90s. And so these became very popular because because they were invested directly into the market. People were seeing incredible returns in the 90s. And so variable universal life became very popular at that time. And they were getting a whole lot more returns on the cash value in the VUL versus whole life and universal life. So these really did well in the 90s. But then what happened after 2000, 2001, 2002? You know, we had the whole 9/11 and the stock market crashed. People saw losses, 50-60% of their portfolios. Some people got totally wiped out and never recovered. But the main thing is these policies can lose money. Okay, they're variable. So the cash value could actually go down on these policies. Whereas here, you know, at least you got an interest, but over here in the variable, the cash values could lose money. And so people did. They lost a lot of money like in the early 2000s. And so this gave rise to the index universal life. So after 2000, the index universal life was invented and actually, well, it wasn't invented in 2000, but it got very popular in 2000, in 2001, 2002, 2003. Because what happened in the index universal life, they took the money that you had in your cash value account and they paid you an interest on that account based on the performance of an index. So an index is a something like S&P 500, Dow Jones. These are examples of stock market indexes. S&P 500 is the largest 500 most profitable companies. They take all their stocks and they measure them on one measurement. And so that's an example of an index. Dow Jones is an index. NASDAQ is an index. Hang Seng is an index. There's so many indexes and there are indexes internationally as well. But depending on the index universal life plan that you choose, they will track one or many different indexes. And then what they will do is they will pay you an interest on that cash value account based on the performance of the index that they're tracking. And normally they will have a maximum interest that they'll pay, and then they'll set also a minimum interest that they'll pay. So for example, maybe the minimum is 1% and the maximum is 10%. I'm just throwing numbers out there. So how does that work? Well, if the index grows, they will pay you an interest on your cash value account, matching the growth of that index. So if the index grows 5%, you get 5%. If your index grows 10%, you get 10%, up to whatever the maximum is that's declared at the time. And so if the declared maximum rate is 10%, then they won't pay you more than 10%, even if the market or that index performs higher than 10%, because that's the max. But what if the market goes down, which we see that all the time? So if the market goes down, let's say it's negative 10, negative 20, negative 30, it doesn't matter because you're going to get whatever the minimum rate is. The minimum rate could be 0, which means that in that case, you just don't get interest at that year. But the good thing about this minimum being set right here is that you know that you're not going to lose any money. So in that case, the minimum is actually very beneficial in a bad market. So the minimum could be 0. The minimum could be 0.5, 0.75. It could be even 1%. So it just depends on the company and the product that you're evaluating. So the minimum could be 0 or 0.5%. The maximum could be 10, 15, 20%. You know, it just depends. And they have different ways, different indexes that they track, and also different ways that they track the indexes, which they call crediting methods. So that's another video. But mainly, this is what I wanted to share with you. And another thing about these policies is that you're going to have an option to choose an increasing benefit, increasing death benefit, or you're going to have an option to choosing a level death benefit. So an increasing death benefit means that when you die, when you pass away, the beneficiary is going to get an increasing benefit. So for example, how does that work? Let's say your cash value is growing from $10,000 to $20,000 to $30,000. Let's say at some point you have $50,000 in your cash value account. This is an example. So let's say you have a $300,000 insurance policy. You're paying and paying and paying, and as you're paying for that policy over time, this cash value accumulates and grows, whether that money is getting interest this way, this way, this way, or this way. But what happens is, when you pass away, what does your beneficiary receive? Well, if you have so I'm going to write it right here. You have the option of level death benefit versus increasing death benefit. You're going to have the option to choose. So in whole life, you don't have the option to choose. But in variable universal, index universal, and universal, anything with this word universal, remember flexibility, you're going to have the option to choose. You want this one or this one. So how does that work? If you choose level, then when you pass away, it doesn't matter how much is here, your beneficiary is going to receive the insurance coverage that you chose. Here in this example is $300,000. That's it. That's level. Okay. Now, if you choose increasing, which you have that option when you choose in universal, variable universal, or index universal, then you're going to receive the insurance money, $300,000 in this example, plus the $50,000 here, which is the cash value accumulated at the time of death. And so the beneficiary actually receives $350,000. So this is called an increasing death benefit. And that is actually pretty popular for people who are younger, 20s, 30s, 40s, especially. They're going to accumulate a lot of cash value. They want that to be added to the face amount upon death. So their death benefit isn't the same for the rest of their life. So this is called an increasing death benefit. Now in a whole life, you don't have that option. It's all fixed. Okay, it's all fixed. But this death benefit. But in the universal, variable universal, and index universal, you have an option. You can choose option 1 or option 2. Option A, option B, level or increasing. So you will have that option to do that in the life insurance. Now, one more thing I want to talk about life insurance is this benefit of this $300,000. In this example, this is the face amount. This is the insurance. What is it good for? So one thing, of course, it's a death benefit. And when you want to purchase life insurance, you want to evaluate your need. What is your financial responsibility? What is your financial risk of loss if something happens to that person that's being insured? So for example, let's say I have a mortgage, or let's say I have young children, or I have parents to take care of, or I have a lot of debt. I want to add up all those financial responsibilities, because if something happens to me, I don't want all that financial obligation to either not be taken care of at all, or it ends up on someone else's shoulders. So this is why we purchase life insurance. So you want to make sure you have enough life insurance to pay off your mortgage if that's you want the house to continue to stay with the family. Let's say, for example, you have young children. You want to have enough life insurance to raise those kids until they're grown up. You want to have enough for their college education. And if you have a lot of debt, maybe a car you want the family to keep, or you have student loans, you don't want that to transfer to someone else if someone co-signed for you, or you have credit card debt or other debt, you want to have enough insurance. So first of all, you want to evaluate your insurance coverage to make sure that you have the proper amount of coverage. And that is very important as a way to choose how much to purchase life insurance, and you may find that you have quite a bit of responsibility, especially if you have a young family, right? So you may even benefit from having some term life insurance and permanent. But permanent is definitely great because it'll be there for the rest of your life. So for example, I have both. I have term life and I also have permanent because I know my term life is going to expire and I don't want to be left with no coverage after that expires. I want something for me and my husband to grow old together and for us to protect each other. So that's the way I'm looking at it for myself. Now, another benefit to this insurance money is living benefits. So what are living benefits? I'm going to make a whole nother video on living benefits, but living benefits are where you can actually access this insurance money while you're still alive. And different plans have different ways of doing that. It could be a terminal condition. You get diagnosed with, stage 4, blah, 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 and you have less than 6 months to live, less than a year to live. Some insurance policies, if you get a terminal condition, will allow you either all of that money to be advanced to you or maybe half of that money to be advanced to you. So this is called a terminal illness benefit. That is a kind of living benefit. Other policies may allow you to access that money for critical conditions. Let's say you get a heart attack, a stroke, a cancer diagnosis, or an organ transplant, or whatever. Every insurance company will have a list of what they consider critical conditions, and they may have a way for you to access the money while you're still alive. That's very important because a lot of people do suffer these types of conditions now, and that may even make them unable to go back to work and sometimes even unable to make the payments on their life insurance. And I've seen people lose their life insurance when these critical conditions arise. So it's great to have an insurance policy that allows you to advance your insurance benefit while you're still alive when you have a critical condition. So look for that type of benefit. Another very important benefit that I'm going to make a whole video about is about long-term care. What is long-term care? Long-term care is when you get disabled and it's a chronic long-term condition. For example, a severe stroke or maybe Parkinson's, Alzheimer's, dementia, so many things that can happen to us where we're not even able to take care of ourselves anymore. And when we get to a point to where people have to take care of us, if you have a policy that has a long-term care benefit, then you can get this money while you're still alive. Some companies will pay you a monthly benefit. And let's say $5,000, $10,000, $20,000 a month, depending on the insurance policy, depending on the way they pay it out. And then you will have money on hand in case of a long-term disability, and that is called long-term care. So these are some examples of living benefits. Nowadays, a lot of these life insurance policies offer living benefits. So you want to look at that. And if you have an older policy that doesn't, you want to consider making sure that you maybe take another policy out that does have living benefits. So these are some of the things that you want to look for. Now, the cash value on the account, you can usually access this through loans or withdrawals. And there are different ways to do that. But the most important thing to understand about cash value accumulation is that the gains in the policy, as long as you die out of your policy, okay, is going to be tax free. So what does that mean? It means if you have interest or you have some return, depending on the type of policy you have, and this money is growing, the growth, the profits, the gains, the interest is going to be non-taxable. And this makes it very attractive to people when they are trying to accumulate money in their policy and they want to use it later for other purposes. You can actually have that money growing and not have to worry about paying income taxes or capital gains taxes. As long as you don't cancel your insurance, you keep your insurance for the rest of your life. So term life policies don't build cash value at all. So these have their place. These are great for people who want large coverage amounts for less premium. If you're on a budget, this could be the way to go. Or if you feel like after a certain point, you don't want to leave anybody anything, then this could also be the way to go because it's going to expire on you. But at some point, you may find that you want to have at least some amount of permanent coverage as well. So permanent coverage, again, you have cash value growing, it does not expire, and you want to find one with living benefits. So this is my simple way, as I hope I kept this simple enough for you to understand how life insurance works. And I will make more videos to go more details about these different things. If you like this video, if you learned something today, please share the video to someone you think may benefit from it. Please be sure to subscribe to our channel so that we can grow our channel, and also comment if you have any questions, or if you have a question, maybe I can make another video out of the topics that you put in the comment section. So thank you so much for tuning in, and I'll see you in the next video.